Right now, the tech sector and AI, to be more specific, is holding up the broader stock market. But if you ignore Nvidia, Google, AMD, and a few other AI companies, there are large pockets of extreme weakness in today's market. Chipotle just recently released its Q3 results and it crashed by about 20% in just one day. And that's just the tip of the iceberg. Popular restaurant stocks like Chipotle, Kava, Sweetgreen, Wendy's, Jack in the Box, and many others are down 50 to 80% from their highs. And it's not just restaurants. Popular clothing brands are down big as well. Lululemon, as an example, is down about 50% over the past year alone. Nike and Adidas are down just as much over the last 5 years. Big pharma companies like Pfizer, Bristol Myers, and Novo Nordisk have also dropped to much lower levels. Business development companies are going through a crash at the moment as well. Major alternative asset managers like Blackstone, Blue Owl, KKR, Apollo are also taking it on the chin. Airlines are down big as well. Spirit even went bankrupt. Finally, even select large cap tech stocks are suffering big. Pfizer just dropped by about 40% in a single day due to disappointing quarterly results. I don't recall ever seeing a company with a 50 billion plus market cap drop so much in a single day outside of the great financial crisis. And that's not the only tech stock that's suffering. Just recently, Duolingo dropped by about 30%. Hims is also crashing down. And again, these are just a few examples, but I could give you a long list. Zoom, Teladoc, Peloton, Upwork, Fiverr, Roku, DocuSign, Unity Software, and many others have crashed 70 to 90% since their highs of the pandemic, and they're unlikely to recover anytime soon. All of this just to say that it's not only REITs that are struggling at the moment. The broader stock market indexes like the S&P 500 have kept marching higher because they have high exposure to select tech stocks that have been winning big. But this masks large pockets of weakness in other sectors of the market. The latest sell-off was largely driven by fears of weakening consumer and labor market, which could signal a potential recession ahead. Just consider the magnitude of the recent layoff announcements. UPS is going to lay off 48,000 employees, Amazon up to 30,000 employees, Intel 24,000, Nestle 16,000, and the list goes on. I'll put a screenshot on the screen so you can see the full list. This has had a particularly big impact on the market sentiment of consumer-facing businesses such as restaurants, clothing brands, entertainment, gaming, hospitality, private credit, and a number of real estate companies as well, including hotels, apartments, and experiential properties. And so how do I react to this type of volatility? Well, if you follow this YouTube channel for a while, you likely will know that I don't shy away from it. When the market dips due to temporary short-term concerns such as a weakening economy or disappointing quarterly results, I typically step in to buy the dips. Yes, the near-term outlook might worsen a bit, but ultimately high-quality real estate should be valued based on decades of expected future cash flow, and therefore these weaker short-term results really shouldn't have such a steep impact on the valuations of these companies. The only reason why the market is so volatile is because most investors fixate at short-term results, are quick to extrapolate recent trends far into the future, and then are quick to forget about the bigger picture, which is that markets are cyclical and good times are generally followed by tough times and vice versa. This is precisely why Warren Buffett has famously said that you should be fearful when others are greedy and greedy when others are fearful, emphasizing that the market has the tendency to overreact due to most investors' impatience. What this means in today's market is that the best opportunities are likely those companies that own high-quality assets with attractive long-term growth prospects but have recently gotten beat down due to temporary concerns which are impacting their valuations. A great example of that would be Caesars Entertainment, ticker symbol CZR. Las Vegas is a bit slow right now and it's temporarily hurting the results of the company, but if you ignore that and focus on the bigger picture, the investment thesis is otherwise stronger than ever. The company still owns the same valuable properties that are waiting to be monetized. Interest rates are now going to lower levels, which will likely lead to lower cap rates on its properties, resulting in higher sales proceeds. The company's digital business is also growing at a really rapid pace. The company is steadily buying back shares at these lower valuations, and therefore I think that, again, this is a case of short-term pain for long-term gain, and so I'm happy to buy the dip in Caesars. We think that the company's real estate alone could be worth as much as its entire enterprise value following its recent crash, and this would still leave shareholders with a very valuable digital business as well as the casino operation business, which it will still have even after doing sale and leasebacks to sell its real estate to unlock value and buy back shares. We think that fair value is ultimately about 3 times higher than today's share price, and we likely won't get there anytime soon if the market remains concerned about the recession and this continues to impact its results. But once again, we think that this is a temporary concern. Recessions don't last forever. It could impact its results for a year or two, but eventually we will have a recovery. And as we go into that recovery, the market will recognize that this valuation doesn't make sense for a company like Caesars, and this could push its share price to much higher levels. Another potentially interesting similar opportunity is RCI Hospitality, ticker symbol RICK. Nightclubs are the ultimate category for discretionary spending, and so it's not surprising that it's suffering right now. If the likes of Chipotle are down 50%, you would expect a nightclub owner to be down a lot more than that even. Add to that the legal risk of the recent state lawsuit, and this is a perfect nightmare for the stock. But the flip side of things is that the valuation is now ultra low if you consider the long-term cash flow generation potential of its moated assets, and the management team has a long history of taking advantage of these discounts to aggressively buy back stock. The legal risk makes RCI more speculative than Caesars as an example, but we are willing to take the chance as one position as part of a big and well-diversified portfolio. Yet another example of a company that I think has sold off too much due to near-term concerns is Alexandria Real Estate, and I've posted a separate video on this REIT on this channel that I'll link in the description of this video. But in short, it's the leading life science REIT, and the life science space is today way oversupplied because developers built way too much following the pandemic, expecting the demand growth to continue for a long time to come, and so now we oversupplied. And unfortunately, the current administration is causing a lot of chaos with new policies, major changes, and this is now reducing the demand even as the property sector is already oversupplied. And so as you can imagine, this is leading to worsening fundamentals. You have occupancy dipping to lower levels. It's harder to refill vacancies. It's leading to more capex for Alexandria. And as a result, it's suffering, and it expects its occupancy to dip a bit next year. It's going to lead to lower FFO. It's likely going to lead to a dividend cut. The risk factors truly played out here, and the company is suffering at the moment. I'm not denying that. But does it deserve to have its valuation cut to just about 1/4 or even 1/5 of what it traded at a few years ago? I don't think so. And so ultimately, I think that this is an opportunity. I think that there's significant short-term pain, but I think that the long-term outlook still remains very attractive today. I think that we're going to keep heavily investing in research and development of new drugs. I don't think that's ending anytime soon. Alexandria owns some of the best assets in this property sector. It has otherwise a strong BBB+ credit rating. Its management has an amazing track record. This is what you would typically describe as a blue chip REIT. And yes, it's going through significant pain. This is going to last likely for a couple of years, but as you move past that, if you can look at what the REIT will likely look like 5 years from now, I think fundamentals will be a lot stronger. I think that the market will have regained balance with demand catching up to the supply, and with that we'll likely see significant upside, and I wouldn't be surprised if the share price is double or triple then. But since most investors cannot look so far, they can only look maximum at 1 to 2 years in the future. Yes, the outlook is bleak, and as a result the REIT is now very heavily discounted. And there are a lot of similar opportunities today in the REIT sector, given that it has gone through a 3 to 4 year bear market as a result of some oversupply and rising interest rates. But I think that this is very attractive environment for more opportunistic, long-term oriented investors who can think like real landlords, like we do at High Yield Landlord, because we currently are seeing a lot of REITs trading at 30, 40, or even 50% discount relative to the net asset values of their properties. And we are very happy to pick up the pieces at steep discounts while the rest of the market is impatient and focusing on short-term results. If you want to access our full portfolio and all our trade alerts in real time, you can join us for a 2-week free trial with the first link in the description of this video. Also, if you enjoyed this update, please consider clicking the like button, as that helps me a lot to keep growing this channel. Thank you very much, and see you at my next one. Bye bye.